Hello, I'm your boss, Joe Boss. Welcome to today's daily plan. This is gonna be a longer daily plan than usual, because we got a lot to talk about today. A lot of stuff happened today. And I want to get everyone caught up on what's creating some of these moves and some of the assets today, because this stuff has just been kind of nutty. You go ahead and you look around the FX space, you look around the commodity space, you look around the equity space. Everything is kind of going all over the place. The vol is increasing just a bit. The expectations are changing slightly. So let's get our new bit of information. So is I go to Financial Juice and I check out, okay, are there any of these red labeled news events that I need to be following? I don't see anything. Oh, there's when industrial production came out. Then I look at the economic calendar. I see, whoa, there's a lot of stuff that got printed for the US and for Canada and for the Bank of England. They had a speech. So there's quite a few things. You had EIA nat gas change. That was a big one. But there's quite a few things, and you can see I got quite a lot of tabs open on this window here to the right. So I'm gonna jump right on into it with the major Bloomberg headlines. First off, Euro area economy is losing momentum. EU says slashing outlook. So let's go to Euro dollar here. And you can see Euro dollar is moving higher. The yield spreads aren't, though. The yield spreads are not looking good. So I'm seeing up moves on negative yield spreads. Maybe you end up hitting this call it sub 107 price range towards the end of the month, because a lot of outlooks from the beginning of this week, so 3, 4, 5 days ago, set expectations for selling rallies, risk-on rallies against the dollar. But let's go ahead and see what's up here. Euro area economy is entering 2024 on a weaker footing, according to the EU forecasts that anticipate another year of subdued growth. Euro area expected to grow less than initially thought. European Commission lowers GDP forecast for this year and for next year. So we have the GDP number, the new estimate, and the November estimate. Let's see here. So they originally, in November, had an estimate of 0.4. The new estimate is 0.8. Yikes. And they lowered it slightly for 2025. The rebound expected in 2024 is set to be more modest than projected 3 months ago, but to gradual pickup pace on the back of slower price rises, growing real wages, and a remarkably strong labor market. And then they talk about 2025, but 2-year ahead outlooks can be quite fickle. Yeah, so to be fair, so far, the deterioration in the euro area outlook has not caused the European Central Bank to reconsider its record high 4% interest rate. So it's not changing ECB rate hike expectations that much. And you can see the growth forecast in different areas. Spain is expected to grow quite a bit. I believe that's Croatia, right? So incoming data continue to signal subdued activity in the near term, Lagarde said. However, some forward-looking survey indicators point to a pickup in the year ahead. So maybe they're talking about second half of this year. Next, a major headline, UK recession deals fresh blow to Sunak's economic promises. We're not going to listen in on that. UK slipped into a mild recession in the second half of 2023, showing Prime Minister Rishi Sunak has so far failed to meet his pledge to grow the economy, and you can visually see it here. So now you have 2 quarters of declining GDP in the UK, officially, technically a recession. UK bonds climbed for a second day with 10-year yields coming off 2-month high. So we can actually bring up the pound. And you can see the pound not impacted too much price-wise by this information. In fact, yesterday, the rebound continued to come through here. But again, these yield spreads are not looking too hot. Let's see here. The recession, though widely anticipated, is further evidence that the Bank of England's campaign to bring down inflation had taken its toll. The figures come at a particularly bad time for Sunak, with voters going to the polls in 2 parliamentary constituencies in England. The latest test of the opposition Labour Party's strength ahead of a general election expected this year. Yeah, as far as I'm concerned, Labour has pretty good chances of winning. The news that the UK slipped into a technical recession will be a blow to the Prime Minister, says Deputy Chief UK Economist at Capital Economics. But this recession is as mild as they come, and timely indicators suggest it is already nearing an end. So maybe they're thinking a rebound occurs in the second quarter of this year. All right. We remain of the view that the outlook for 2024 is brighter, something the Bank of England has also been keen to emphasize. So the Bank of England, just like the ECB, is not changing their rate hiking expectations based off this information. Next, Japan loses its spot as world's 3rd largest economy as it slips into a recession. Yeah, Japan's economy unexpectedly slipped into recession after shrinking for a second quarter due to anemic domestic demand. And we can go ahead and bring up the dollar yen here. And you can see the yen falling a bit yesterday. And yeah, again, this is quite high, quite strong moves. The report showed both households and businesses cut spending for a 3rd straight quarter as Japan's economy slipped to 4th largest in the world in dollar terms. Germany now has the world's 3rd largest economy. So Germany's now overtaken Japan. The weaker than expected result will complicate the BOJ's case to conduct the first rate hike in Japan since 2007. So this is changing BOJ expectations. This is a headwind for the BOJ. I think there was a feeling that the BOJ will end the negative rate in March or April, but a north wind is now blowing. And you can see the 2 negative prints right here for quarter 3 and quarter 4. It's a slight negative print. The BOJ's policy board has recently ramped up discussions surrounding an exit. Yep. The surprise contraction in 4th quarter GDP puts Japan in its technical recession and casts strong doubt over whether the Bank of Japan will follow through on signals it sent in January, pointing to a quick retreat from its current policy stance. Sticky inflation is cutting into consumers' purchasing power, leading to weak economic consumption. That's mild stagflation. All right, said the BOJ rate hike in March is now virtually eliminated, though he still expects a move in April. So the probabilities for a rate hike in April are getting shifted. Well, a rate hike in March are getting shifted to April. And I'm guessing net the rate hike expectations in April are more dispersed and more uncertain now. Looking ahead, external demand may become a less dependable source of support for growth in 2024, as some of Japan's key trading partners are expected to see growth decelerate. So this isn't just a Japan story, this is a Japan trade story. In its latest quarterly outlook published last month, BOJ said the economy is expected to be under downward pressure stemming from a slowdown in the pace of recovery in overseas economies. And Putin made a comment saying, hey, I think I'd like to see Biden run for president. I'm not quite too sure how to feel about this. Considering during Putin's interview, he said, I don't really talk to Biden. And now he's saying, yeah, I think he's good. There's probably some logic to this point of view. That defend NATO, right? Still, Putin denounced the Biden administration's approach to Russia as harmful and mistaken. There's the comment, if you don't pay NATO under a Trump presidency, they'll let Russia do whatever the hell they want. It'd be interesting if Trump saying this is making Putin respond like, maybe we should have Biden because we don't actually want to do whatever the hell we want. That'd be an interesting little theory. I was not prepared for this. I didn't want this. Yeah. Because it could give me the opportunity to respond with equally sharp answers. Right. Again, a little bit of geopolitics. SpaceX going to the moon. If successful, Intuitive Machines will claim a title that has eluded numerous companies and nonprofits who have a shot for the moon in recent years, first to land a privately built spacecraft on the lunar surface. As it is working on Nova C, the initiative went public in a 2002 blank check deal. All right. We got a bit of a space race here. Lunar Nova C will attempt to touch down on the lunar surface February 22nd. So, and I pulled this up from the Bank of Canada because USD CAD was a huge, huge mover today. Look at that reversal. This is a 80 pip, 79.4 pip reversal on the day, retracing pretty much this whole move. And I still had expectations of going slightly higher. Again, this is a distribution of where likely tops for the month are going to come in. So I just went to just into this peak on the distribution. I was expecting for it to go a bit higher. I was expecting for it to reach 136, but now that kind of looks out of sight here. However, if you notice, the yield spread's going from negative now to more positive. That is net not a good thing to see, especially if come March, when we get the Fed dot plots, if the Fed dot plots are more hawkish when they hold their policy in March, that would put you up here. So this is a particularly interesting Bloomberg article, all things said and done, specifically because of this. I found this hilarious. The bank can always find a number to suit its narrative when referencing inflation. You never know which side of the bed they'll wake up on. Governor Tiff Macklem, the guy who's in charge of the Bank of Canada, has pushed back against the focus on a specific inflation indicator, describing core inflation as more of a quote-unquote concept. And then this is the main problem here, this little chart here. There's no broad consensus across all these different CPI indicators where inflation is going. So the Bank of Canada doesn't really know, doesn't have certainty as to which of these numbers apparently they should be tracking their policy against. Yeah, failing to exclude those measures means, let's see here. Yeah. Last week, Macklem signaled officials may be starting to reach similar conclusions, saying monetary policy can't solve housing shortages that are driving up costs. For some economists, that suggests policymakers may consider looking beyond shelter inflation as they weigh how long to keep interest rates at current levels. So this is adjusting the Bank of Canada rate hike path expectations because now there's more uncertainty about when the rate hike is going to be. So it is a hawkish tilt here. A hawkish central bank might choose to focus on the inflation measures above 3%, while less hawkish will focus on those closer to 2%. Therefore, the tone of Governor Macklem's press conference will become increasingly more important than any new data releases. So everyone who's participating in Canadian markets are going to be watching what Macklem says next. And then here, this is for Nat Gas. Nat Gas has just been going lower and lower and lower, and it made another new low here on the month. Go ahead and turn these off real quick so it's easy to see. I mean, that's pretty bad. But today the House voted to pass legislation that would effectively undo the Biden administration's freeze on new liquefied natural gas export approvals. While the bill isn't likely to be taken up in the democratically controlled Senate, its passage on a 224 to 200 vote, including 9 Democrats, would embolden House Republicans to include language easing the pause on nat gas exports in future government funding legislation. So there's now a legislative government risk that more LNG supply from the United States actually can come online later this year. In announcing the halt last month, the Biden administration said it would scrutinize how the LNG shipments, which have tripled in the last 5 years, affect climate change. Yeah, that was the reason given. But it was just by consensus very, very unpopular. But net gas prices are falling lower, and this could make net gas prices fall even lower. The pause, which the administration has not put a firm timeline on, has left projects in limbo, including proposals by Venture Global, Commonwealth, some major LNG projects. It comes amid fervent opposition to the projects from environmentalists and progressive voters who President Joe Biden will need to win re-election on. And if this is passed, it's not going to help Biden's re-election campaign. Next, something from the DoD. MDA SDA confirmed successful launch of the hypersonic and ballistic tracking space sensor and Tranche 0 satellites. On Wednesday, the Missile Defense Agency, the MDA, and Space Development Agency, SDA, confirmed the successful launch of 6 satellites to low Earth orbit by SpaceX's Falcon 9 rocket. The satellites, which include 2 satellites for hypersonic and ballistic tracking, and the final 4 SDA Tranche 0 tracking layer satellites of its proliferated warfighter space architecture were safely delivered into orbit and conducting initial testing and checkout. So the US now has more ICBM and hypersonic missile tracking capabilities. And if you can track the missiles, you can more easily shoot them down for deterrence. So, Russian supersonic missiles, eh? The US does a pretty good job in defense. A statement from Secretary of Defense on today's NATO Defense Ministerial meeting in Brussels. And this is just the printout of what they said at the NATO meeting. The United States will continue to stand with our NATO allies and to defend the sovereignty of the territory of every alliance member, every inch of it. As President Biden has repeatedly made clear, our commitment to Article 5 remains ironclad. U.S. leadership on the world stage will not diminish, and we will continue to strengthen our bonds with our deeply valued allies as we look toward NATO's historic 75th anniversary summit in Washington. All right. And this is something to keep an eye on. Bank stress tests from the Federal Reserve. This year's test will attract heightened scrutiny from investors, analysts, and regulators following the failure of 3 banks last year, as big banks are fighting the Fed over proposed new capital hikes that they are saying are excessive. The growing tests come amid growing worries over lenders' exposure to commercial real estate after the New York Community Bank last month reported losses on sourced CRE loans, tanking its shares. The commercial real estate sector has faced the twin challenges of financing difficulties amid high interest rates and lower office occupancy due to widespread adoption of remote work. Overall, this test is broadly in line with last year's. So, saying from this financial stress test what you could say security is with the current state of these new institutions, because it seems like there will be potentially some new stress tests coming in to check for the problems similar to what NYCB has had and Signature. We'll see if there's any new information about kind of the liquidity and the reserves available in these US banks look like. Now, I have quite a bit here on Australia and New Zealand. And Australia rebounding nicely, but those yield spreads are terrible. Those yield spreads are pretty bad. Don't get me wrong, they could improve, but they'd improve more or less on the long to medium term of the curve, not so much on the short end, the 2-year and lower. So Australia's unemployment hits 2-year high as jobs growth sputters. Again, this is from technically a day ago, but it was printed today. Australian employment was surprisingly weak in January, while the jobless rate climbed to a 2-year high, in another sign the labor market was loosening in the face of a slowing economy and subdued consumer demand. This is actually impacting New Zealand quite significantly, because now people aren't going to New Zealand for their holidays. Australians aren't. They're going to Indonesia there's more people going to Indonesia for their holidays. It's a bit more affordable. And then we can see here natural gas weekly update from the EIA. And remember, we had here EIA natural gas change. That came in less negative than expected, and the print. So let's check this out here. Natural gas spot prices fell. Oh well, I'll read this out. Natural gas spot prices fell at most locations this reported week. Price changes ranged from a decrease of 64 cents at Milan to an increase at $1. Prices in the Northeast were volatile. Prices in Texas decreased. Prices in the Midwest also remain historically low for this time of year. Prices in the West decreased. So across the board, from all these producers, prices are decreasing. Let's see here. And in the Netherlands, they're falling. According to data from S&P Global Commodity Insights, the average total supply of natural gas fell slightly. Total U.S. consumption of natural gas fell 2% compared to the previous report week, according to data from S&P Global Insights. Yeah. So demand is falling, supply is not falling as quickly. Right, and there's the red count, storage. Right. Next one. So let's see here. What was this? Oh, this is about a bunch of banks in Australia having outages. At least 6 banks in Australia affected by network outages with payments, transfers, and accounts access hit. In short, at least 6 financial institutions in Australia experienced technical issues on Thursday, with customers impacted by payments and online banking difficulties. Banks were impacted included these banks here. I recognize a few of them. What's next? Several of the banks have removed their notices warning customers of issues and say that the issue is being monitored closely. So, yeah, you can see some outages on banking, online banking apps, but credit card payments, home loans, call centers, operational. Oh no, we ask customers to look closely at their accounts prior to resubmitting payment to avoid duplicates. Oh no. Anyways, this is ANZ. This is Elise Zollner. Yeah, Sharon Zollner. She talks about the RMB could hike. So let's pull up New Zealand. And we are getting our rebound, but it looks like New Zealand's positive yield spreads are going away. They're quite mixed. What's left of the positive move from the yield spreads is coming from lagging effects. So this isn't looking so hot here on the New Zealand side of things. So ANZ Research has revised its forecast for New Zealand's OCR, which is the Reserve Bank of New Zealand's cash rate, predicting an increase to 6% with 2 additional rate hikes expected by April 2024. And I remember reading a week or two ago that ANZ was saying, hey, hold your horses. Literally saying, hold your horses, on people calling for a rate hike from the RBNZ. This adjustment marks a significant pivot from ANZ's January prediction that suggested a series of OCR cuts beginning in August. A lot of small pieces of data rather than a single transformational insight. Speaking on the 5 and 5 podcast that ANZ does, Zollner noted the global financial community's focus on the RBNZ, viewing it as an early indicator of broader economic trends. New Zealand and the US is pretty highly correlated, she said. In fact, New Zealand's pricing intentions explained US inflation better than it does on our own. If the Reserve Bank does follow through with a hike in February, despite the fact that the economy is obviously weak, I think that would certainly get some international attention. The potential for a February hike by the RBNZ, despite New Zealand's economic fragility, could attract significant international attention. Zollner pointed out that the RBNZ was among the first to initiate post-COVID rate hikes, accelerate them. Yeah, people thought, all right, we got that. We don't think the Reserve Bank was bluffing. We think they were calling it like they see it. And if that's the case, they'll actually, that close to the line, it's not going to take much to push them over the line. So ANZ more cautious. And I follow Zollner quite closely. She has particularly good commentary. But then I found this piece when I was doing my searches. ANZ accused of restricting cash and cutting jobs as branches go cashless. ANZ is slowing moving cash withdrawals away from an over-the-counter teller transaction and is instead asking customers to use smart ATMs. But is that costing Aussies their job? The first Australian bank confirmed the process was being adopted in some inner cities. So, yeah, some stuff going on with ANZ. Kiwi households, so again, this is another New Zealand related thing. Kiwi households grapple with persistent affordability challenges. It's pretty hard to get a home in New Zealand. Mortgage repayments as a percent of gross annual household income have stalled at 49%. Let's see here. The stability in mortgage servicing in recent quarters isn't really much consolidation. Housing affordability is still significantly stretched on this measure, given that the long-term average is 37%, illustrating the current challenges from high mortgage rates. And if the RBNZ were to hike, that would push this number even higher. The RBNZ is not in a good spot hiking into an economy where people are already quite financially pressed. Home ownership, renting, and affordability issues. Let's see here. Yeah, first deposit is really hard. The renting market is not exempt from affordability issues, with rents consuming 26% of gross household income, matching previous highs. Rental affordability has worsened in Christchurch, making it the second most expensive city for renters after Tauranga. Outlook on affordability. It's conceivable that prices may only rise roughly in line with incomes over the next few years. That wouldn't necessarily see affordability improve, but it might not get much worse either. So, core logic, expecting net things to remain stable. The easiest forecast is naive forecast, everybody. The prices today are going to be the prices tomorrow. And from another New Zealand bank, ASB Economic note, resilient migration likely to support case for later OCR cuts. So this is kind of the other side of the story. Let's see here. A seasonal travel uptick, but still in a hole. All right. Upshot, no OCR cuts just yet. Today's travel data, particularly the migration figures, continue a recent run of data pointing to the resilience of some key statistics. Migration data are tricky for the Airbnb to parse because they have both demand and supply effects on the economy. The Airbnb specifically called out the demand implications in the last MPS, though. That's their speech for their rate decisions. And we'll be keeping a wary eye on the numbers from that perspective. We don't think the threshold has been met for any additional OCR increases, but the risk is distinctly skewed to a later start to cuts than our August forecast. So even though they're saying, well, maybe they don't do cuts, but now the likelihood of cuts might get pushed back into even Q4, that's not particularly helpful. Oh, this is a speech from Bank of England. This is a speech from Governor Waller at the FOMC, dollar's international role. Again, it's quite a read. I'll be going over that later myself. I'll be posting it in the Discord. Empire State Manufacturing Survey. The survey of manufacturers in New York State conducted by the Federal Reserve Bank of New York. Well, the current value rebounded. It's almost in positive territory. It's still net negative. Business activity edged slightly lower in New York State, according to firms responding in the February 2024 Empire State Manufacturing Survey. The headline General Business Conditions Index rose 41 points but remained negative. So quite a significant change, although on an absolute level, not where we want it to be. New orders declined. Shipments edged higher. Unfulfilled orders continued to shrink. Delivery times continued to shorten. Inventories declined. Employment levels stayed a little unchanged, but the average work week fell. And we got some analysis here from Wells Fargo on some of the economic indicators we got this morning, like retail sales. So summary, the broad-based drop in January retail sales suggests the consumer lost some momentum in the start of the year, yet a strong gain in food services sales implies service consumption remains sturdy and likely offset some of the weakness in goods consumption. So services are still keeping things up and up. We can actually view the breakdown here by sector. So net negative. And it seems the biggest contributor was building materials, miscellaneous. I wonder what's there in miscellaneous. And then autos. Furniture was a big positive there. Consumer resilience is positive in the sense that it helps ward off economic contraction, but could be problematic if it gets in the way of the downtrend in consumer inflation. So they're saying that this is a risk to actually keeping CPI from coming down as quickly as we might expect it. This week's inflation data showed the consumer price index, CPI, came in hotter than expected. The data did a little to give the FOMC the greater confidence, quote unquote, it needs to start immediately cutting rates. But the final mile is getting back to 2% target is expected to be bumpy. How consumer demand evolves will play a key role in continued disinflation. And the pullback in January sales suggests some lost momentum. And then here we are, manufacturers waiting for lower rates. Activity in the industrial sector of the US continued to stall in January, demonstrating that even as rate cuts are on the horizon, current production remains constrained. And we'll likely see this get more constrained as we go into the second quarter. Oh, check this out. But despite the weak outrun for January, there are some early signs that the industrial sector may be on the cusp of a recovery, as recent data suggests activity may be turning a corner. Shipments and new orders for durable goods ticked up at the end of last year, and the ISM Manufacturing Index signaled the slowest pace of contraction in the sector in more than a year in January. And then also suggested some improvement in February. Uncertainty over the timing of rate cuts continues to be the biggest hurdle for manufacturers as it eats into businesses' new capital spending plans. While recent inflation data may go against an imminent rate cut, the widespread expectation remains that the Fed's next rate adjustment will be lower. That could be quite a ways away. Come on. It's simply becoming a question of when and how much will likely help support investment this year, even if the recovery comes at a gradual pace. So slightly optimistic so long the turnaround comes in on the manufacturing side, but it's still in question. And this is a piece of special commentary from Wells Fargo. They're doing this whole series on the United States debt, and they're going down by major components. Let's see here. They did household debt, non-financial corporate debt, and now they're doing government debt. And I'm going to take a read on this later on. And if you're interested in following the Mexican peso, I believe, yep, there we go. Down on this chart means a stronger peso. Up on this chart means a stronger dollar. Mexico's central bank has inched towards interest rate cuts. Again, I'm not trading the Mexican peso, but being aware of the United States' major trading partners and how they're doing economically is going to be important, because there's a lot of business that the U.S. does with Mexico. And if Mexico is doing well, if demand and manufacturing is growing in Mexico, that is sometimes a precursor that, hey, there were orders coming in from the United States to up that manufacturing. And then this is a breakdown on NVIDIA. The coming AI chip slowdown. The United States keeps patching up its clothes. Why should we continue to follow their standards for the new clothes we've been making these past few years? So this is a bit of a recap on NVIDIA and China at the moment. NVIDIA CEO Jensen Huang dancing in China. I know Atroc is going to talk about this, but I just know he's going to talk. I know he's going to talk about it. I know he's going to. Indeed, 2023 was NVIDIA's dream year. The special supply isn't well received. Currently, the total size of the AI chip market in mainland China is about $7 billion, with NVIDIA holding over 90% of that market share. Let's see here. Originally, NVIDIA's plan was to use its brand and exclusive products to stabilize its major consumers in the Chinese market, and then wait to see if US policies would relax. Yeah, there's been a problem with NVIDIA trying to sell product to China. Again, this is something that I'll post in the equities channel. And as a little side piece, I got this chart from Apollo. Chief economist at Apollo, Torsten Slok, I believe. The rise and fall of AI. And if we look at this, the rise and fall of AI, the number of times the word AI, machine learning, and generative AI phrases were mentioned in earnings calls. And you can see going into the third quarter 2023, the word count was just going up and up and up, and now it's falling down. So when this title here talks about the coming AI chip slowdown, that is additional confirmation of this narrative. And let's see here. Commodities Weekly by MUFG. So they have bullish expectations on gold. Gold getting a nice little rebound here. Yeah, it is hard to figure out where the low is going to be there in that spot. But yeah, going past 1990 would be particularly harsh. I'd be concerned if gold went any lower this month. I would like to set an expectation that that's the low for the month on gold. We can go ahead and check things out on the week. Yeah, check that out. I would like to set that as the expectation for the low, but you're going to need to see a bit more. I mean, hopefully gold closes in the 2020s handle, and you see these ranges move up. And if you do get any sort of pullback, the pullback is just in the 2000s handle, maybe anywhere between a 10, 20 point pullback and then going higher. Gold going, it's not going to be great for the gold market if it continues falling here into the end of month, because at that point you're essentially guessing where the low is going to be. And next month isn't especially any more bullish. Let's check out the ranges here. Yeah, similar view as on the month, as on the week. Check out our closing odds here real quick. Yeah, it's got room for more continuation higher into the end of the week. It's just a matter of, do they get it? Do they get it? And I have a feeling this is going to be mostly determined by continued dollar moves lower. Just look at that. I'm pretty proud of this week's trade plan. Well, not this week's. This was the trade plan I made Thursday of last week for the week ahead. Yeah. And tomorrow we'll be doing a week ahead trade plans for all these assets, taking all this information into account. So real quick, I'm going to also bring up the ES. S&P, what a great recovery. Absolutely fantastic going into the nominal closes. I had more conservative expectations for where the close is going to be, but I'm glad my expectations are being exceeded in the direction I had set them in, which is from down here, which was 2 days ago. I said, oh, I would expect a rebound now. And if the rebound, stay conservative on the rebound. I believe on the NQ, I set a range here. And it seems like now this is going to be more reasonable to go even a bit higher into the close to actually end up potentially above the 18K handle on the index. This is quite good. Now, if you were day trading this, you probably didn't feel all too good because there was this candle here, these candles here that pulled back super hard. But you know what? Likely low. That is a likely low. Wow. What a snappy day. Quite a volatile day going into the close here. Sold off on the open and totally reversed going into the close. So, yeah, we'll see how tomorrow ends up playing. But I'm glad that my expectations, at least for the week, on where we're going to end up, yeah, they're not going to end up exactly where I think they're going to compared to 2 days ago. but I'm just glad my expectations were met in the right direction. Good stuff. Again, if you're gonna be looking at markets and things change, you have to adapt and set new expectations as new information comes in. What I set as my expectations for 2, 3, even a day ago can change as new information comes in quite rapidly. So you always want to be protecting yourself, and you always want to be leaving the door open for better expectations than you set, or worse expectations. You always got to be thinking about the different chaotic outcomes that can come from these markets. Okay. Well, with all that said and done, I'm pretty much set here. I'd like to check out crude. Looks like crude is going to reach my net expectation of where I thought we were going to close. So that's on point. And pull up the DXY chart. Alrighty, guys. Thank you very much for watching. I know this was a more research, news, heavy based outlook. I don't think I've covered every single chart that I usually cover, but the information that has come out today to go down all those tabs of information is, I think, explicitly important when setting expectations going into the week ahead. And I'm going to be getting probably another 100-200 emails going over the new set of expectations for the week ahead. That's just stuff that's developing that came out today. So we got our work cut out for us over the next 48-ish hours as far as following up with market expectations and setting our expectations for how markets could move going into the week ahead. So thank you guys very much for watching. I've been your boss, Joe Boss. And I'll see you guys in a bit.